Today I want to talk about how a massive short squeeze is coming, about how there's factual proof to support this, and I want to talk about what will trigger the squeeze. So stay tuned and let's make some money. And I want to dive straight in with the key information. So, Game of Trade tweeted saying hedge funds are short at record levels. If they get caught on the wrong side, it will lead to a massive short squeeze. This data that comes directly from JP Morgan Equity Derivative Strategy Team says that hedge funds and asset managers are record net short in US equity futures. These hedge funds and asset managers have built record over-leveraged short positions in a number of different stocks like AMC, GameStop, Ape, and many other highly shorted stocks. We can see towards the end of 2021, hedge funds as a whole across the entire market were net long on around $200 billion worth of stocks. But right now in 2022, these asset managers and hedge funds have a record short position of around $50 billion short. Now, this is the latest up-to-date data as of the 20th of September 2022. This data isn't from 5 years or 10 years ago. This data is happening right now. Therefore, we can clearly see many of these hedge funds and asset managers are way over-leveraged on their short positions in specific stocks like AMC, GameStop, and many others. And as Game of Trades pointed out, if some of these hedge funds get caught on the wrong side, it will lead to a massive short squeeze. What kind of hedge funds, large institutions, market makers, and major banks are actually net short, and how exactly will this trigger the squeeze? Well, as Peruvian Bull pointed out, the Credit Suisse CDSs or credit default swaps spiked again today to an all-time high, even surpassing the 2008 financial crisis level. He said the one-year contract went vertical, up 440 basis points in a single day. He said Credit Suisse have $1.6 trillion of assets under management, and right now they're in meltdown mode. We can see from this chart previously a few days ago, I pointed out their credit default swap level was just peaking that of the 2008 financial crisis, around 300 basis points. But now this is shot to new record highs around 505 basis points, nearly twice as high as it was back in 2008. That means that right now Credit Suisse are approximately twice as likely to go bankrupt right now, this week or next week, than they were back in 2008. But as Gold Telegraph points out, it's not just Credit Suisse. They've said the UBS credit default swaps are now also at a decade high. They also reinforced by saying the Credit Suisse credit default swaps are now at a record high, higher than they were back in 2008. And they added saying in March of 2022, so around 6 months ago, the Swiss government proposed public liquidity backstops for big banks in case one of them fails. So back in March of 2022, the Swiss government did announce they may end up bailing out one of the major banks if necessary, but how big the bailout will be is yet to be seen. We know that in history, Europe have been less likely and less forthcoming into giving bailouts, and therefore, I wouldn't even guarantee this Credit Suisse bailout. And on top of that, it's not just Credit Suisse, it's not just UBS, but also Goldman Sachs' 5-year credit default swaps are also rocketing to new highs over the last few days. We can see since January, the Goldman Sachs credit default swaps have risen from 60 basis points all the way to 143 basis points, so they've increased by over double. As I said in one of my previous videos, it's not just going to be one isolated bank that ends up failing. I personally believe there will be contagion, and there will be a massive domino effect, and potentially all of the banks may end up coming down. For example, if Credit Suisse or UBS end up failing, it won't just be Credit Suisse and UBS that need a bailout, it could be the entire American financial system. Now you may say, Tom, just because Credit Suisse's credit default swaps have gone absolutely catabolic, catastrophic, it doesn't mean that Credit Suisse is actually close to going bankrupt. But to that, I have to say that it's very important to remember how credit default swaps are actually priced and who specifically can influence the price of CDSs. Retail investors can't trade credit default swaps. People on Twitter can't trade credit default swaps. The only people that can trade and influence the price of a credit default swap isn't social media rumors, it's hedge funds and other large institutions. These hedge funds and other large institutions are trading Credit Suisse as if it's about to go bankrupt next week. And guys, if you haven't already, be sure to sign up to Moomoo right now using the link in the description below. You can currently get 15 free stocks worth up to a whopping total of $30,000. Moomoo obviously doesn't accept payment for order flow, and they don't route your trades through market makers like Citadel or through clearing houses like Apex Clearing. Therefore, Moomoo is brilliant for buying those AMC, those GameStop, and those Ape shares. Now, on top of that, the Swiss National Bank has actually been monitoring the Credit Suisse situation very closely, and Charles Gasparino tweeted saying, breaking news, US investment bankers tell Fox Business the Swiss National Bank has weighed merging Credit Suisse with another bank such as UBS. But remember from this tweet here, UBS's credit default swaps are now also at a decade high as well. Therefore, a merger between Credit Suisse and UBS wouldn't necessarily make the most solid of financial institutions, considering both of them are very likely to go bankrupt. He said right now he's unclear if there is official talks of this merger or if it's just rumblings, but the growing consensus is there isn't need for both institutions competing over the same turf. AK is basically saying both UBS and Credit Suisse are struggling right now, and maybe merging them would resolve the issue. But as Hang Loose tweeted, he said, remember, the only time banks talked of merging like this before was in 2008 to stop from defaulting. Now, this is a clip from the film Too Big to Fail, where they're discussing merging a number of different US banks to try and build powerhouse too big to fail banks that simply wouldn't end up going bankrupt.
Goldman and Morgan Stanley are going down now. We gotta do something today. Like what? The market doesn't like investment banks, right? Money's the whole business model. Yeah. So merge them with commercial banks, turn them into regular banks regulated by the Fed. They can use depositors' cash with them access to the discount window. It's cheap government cash. You want to make them bigger? It's a trade-off. The upside is it'll stabilize them. The downside is, yeah, they'll be really big. Do it too.
If you haven't yet seen the film Too Big to Fail, I really encourage you to go and watch it because it's a brilliant film that discusses the 2008 financial crisis. And speaking of Credit Suisse, Jack tweeted saying, check this out, it's so telling. All of those European banks like Credit Suisse, Deutsche, UBS and many others have been involved in allowing hedge funds and family offices to make risky multi-billion-dollar bets with their customer loans. He said these European banks are the ones that we're fighting against because they're the ones making these loans to family offices to leverage short stocks like AMC and GameStop. This article is titled Credit Suisse Settles Their US Shareholder Lawsuit Over the Archegos Default. It says Credit Suisse was accused of playing a kind of high finance game of Russian roulette by letting hedge funds and other blue chip clients make risky multi-billion-dollar bets with their loans. At the same time, the institutions had publicly committed to managing its risk limits, risk monitoring and credit exposure, according to Reuters. Credit Suisse's laissez-faire approach led to at least $5.5 billion worth of losses, including the collapse of Archegos and British financial firm Greensill Capital. Obviously, these hedge funds were using these multi-billion-dollar loans to place multi-billion-dollar short bets on AMC and GameStop, leading them to have very heavily over-leveraged and over-risked and overexposed positions. And as Jack tweeted as a key piece of info, it wouldn't be that far-fetched to think that all of those European banks who are currently facing a credit default swap crisis have been involved in providing credit to short sellers taking high risks betting against meme stocks. Many of these hedge funds and family offices needed tons of money to make these overexposed short bets and needed a way to hide them. Credit Suisse gave them the perfect option to lend them billions of dollars and enter total return swaps with them. That way, these hedge funds and family offices could build multi-billion-dollar short positions in AMC and GameStop, and they could all do that selling the float multiple times over through these total return swaps. But considering that Credit Suisse is on the brink of bankruptcy, it won't be long until all of these trades are unwound and all of these hedge funds have to close out of their short positions. And as the former SEC branch chief Lisa Braganca tweeted, she said we should be concerned about Credit Suisse and the Fed's plunge protection team. This article says at 6:53 AM this morning on October 4th, Dow futures were up 454 points, but no one who has been a trader on Wall Street or a stockbroker for multiple decades believes this rally is real. Wall Street veterans are thinking that either the Fed's plunge protection team or the Treasury's plunge protection team is behind the rally. And it says as equally unbelievable as the chart above indicates is the fact that major mega banks on Wall Street closed in the green yesterday, and many of these are counterparties to Credit Suisse derivatives and thus subject to the potential for contagion. It says Wall Street traders are not going to believe the Dow can stage a legitimate rally or even a short squeeze rally when a GSIB or global systemically important bank such as Credit Suisse is blowing out its credit default swaps. And Dennis Keller from Better Market said as the financial condition of Credit Suisse continues to deteriorate, raising questions on whether it will collapse, the world and US taxpayers should be deeply worried as multiple simultaneous shocks shake the foundations of economies worldwide. It's crazy to see the plunge protection team is trying all it possibly can to keep Credit Suisse afloat just for a few more days to avoid that mega short squeeze scenario. Because we know that when Credit Suisse crashes, it will cause the wider economy to crash, and many of these hedge funds that are currently record shorting AMC and GameStop will be caught on the wrong side of a major short squeeze. But guys, be sure to let me know what you think down in the comments below. And as always guys, be sure to ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.